Welcome back to What's Hot and What's Not CRE, your daily pulse on commercial real estate in America. I'm your host, Rachel. Today we're digging into the regional picture, looking at a crystal ball of sorts to see which markets are projecting the absolute strongest rent growth heading into 2026. Let's jump in. So, what's hot? Who's leading the pack? Well, to probably no one's surprise, it's the tech hubs. San Jose is projecting a massive 4.3% rent growth for 2026. That is the highest in the entire nation. And right on its heels is San Francisco, coming in at 4.2%. What's driving this? It's really a perfect storm of the AI boom pulling in talent, and those return-to-office mandates finally taking firm hold. This is creating incredibly strong apartment demand in two metros that are already famously constrained on supply. But here's a name that might surprise you. Rounding out the top three, also projecting 4.2% growth, is Norfolk, Virginia. Seriously, this is a market that, frankly, wasn't on most investors' radar screens just a year ago. It's a fascinating one to watch. Of course, we have to talk about South Florida. The region is still proving incredibly resilient. Miami is projecting a strong 3.8% growth, with Fort Lauderdale close behind at 3.5%. Despite all the talk of a Sunbelt slowdown, the constant stream of both international and domestic migration continues to fuel demand down there, offsetting some of the new supply we're seeing elsewhere. Now, let's turn to a region that's quietly becoming a powerhouse: the Midwest. It's really making some moves. Cincinnati and Columbus are both projecting 3.1% growth. Detroit and Kansas City are right there at 3.0%. A key factor here is incredibly high lease renewal rates. Get this, Detroit is seeing renewal rates of nearly 69%. That, combined with lower supply growth compared to other regions, is creating some very tight market conditions. The Midwest is a story of steady, solid outperformance. And one more hot market to mention. Seattle is making a comeback. It's projecting 3.7% rent growth, really benefiting from that tech sector recovery. And again, a theme of limited new supply. Okay, so that's what's hot. What's not? Well, the flip side of the Sunbelt story is the supply glut. Austin, a market we've discussed before, is facing rent declines of around 5% due to a massive, and I mean massive, oversupply of new units. Phoenix and Dallas are also in that same boat, really struggling with elevated vacancy from their recent construction booms. Across the board, the luxury segment is also feeling the pressure. Vacancy rates remain above 10% in Class A properties nationwide. All that new construction at the highest price point is still finding its footing and struggling to stabilize. This really underscores that the recovery is not a national wave. It's extremely regional. Markets that were recently darlings, like Orlando and Nashville, are now moderating as all their new supply finally hits the market. It's a very uneven picture out there, and that's your regional rent growth update. The big takeaway for today? Tech markets and the Midwest are heating up, while many of the oversupplied Sunbelt metros are definitely cooling off. Thanks for tuning in. I'll see you tomorrow. And don't forget to like, share, and subscribe. For more details and to get our weekly newsletter, visit hotnotcre.com.